please join me in welcoming the following: Bruce Huber, CEO, Alexa Capital; Dr. Barbara Weber, founder and managing partner, B Capital Partners; Kylie Fox, founding partner, KFR Capital; Kevin Teo, principal Capital Dynamics; Nicola Beretta, principal Infrastructure Capital Advisors.
Good morning, everybody. I'm going to ask my panel to come up if we could and settle in. Welcome, everybody. We're going to dive right in, and before we kick off, I mean, I think everybody is aware that we've got a topic that we'll discuss how capital solves some of the issues of the energy transition. Before diving in, I'm going to ask each of our panelists to give a brief introduction. Barbara.
My name is Barbara Weber. I am based in Zurich, B Capital Partners. It's a company focused on next generation sustainable infrastructure. We operate in the lower mid-market. What else? I founded the firm a little over 20 years ago. I've been in infrastructure since almost 30 years now, starting on the debt side before I moved into the equity side.
Kylie Fox. I founded KFR Capital a few years ago. I came from a private equity and banking background, previously very sector agnostic, and worked across equity and debt quite intensively. And then our view is that there's a massive opportunity in the energy market, the exponential growth in terms of the need and the power needs and the solutions required, and also that there's solutions that don't necessarily exist today. So that means going behind the meter and finding power to allow us to keep growing our economy, whether it's behind the grid, whether it's using natural gas, renewable sources. We just like to find solutions and provide it to industry so that it can continue their growth. And today there's sort of grid infrastructure issues, and there's not enough power to power up the developments that are required. So we are slotting into that and providing the growth equity that's required to get the development and the projects up and running. So we invest at the SPV level, and there's just endless projects and investments that are required both in the US and also across Europe and the GCC.
Thank you. Nicola.
Good morning, everyone. I hope our panel is going to keep you awake and hopefully also interested. So we'll try to make it as much as possible interactive among us, but you don't mind if I'm saying, happy if anyone in the audience would like to contradict us or pose some questions. So making it a dialogue would be much more interesting for us, and I hope for you as well. Nicola Beretta, I'm a partner in a relatively small and specialized firm called EOS Investment Management, which has 4 funds, 2 focused on private equity and 2 focused on real assets. I am on the real asset side, so I'm kind of boring, just focusing on the tools, the panels, the windmills of this world. And more we see these 2 sectors getting closer and closer. We'll discuss further during our conversation today. Just to give you a little bit of a focus, the latest funds is 300 million, and we are specifically focusing on projects in Italy and Spain. So we'll be happy to give you some personal thoughts of the development of the sectors, not only from a technical perspective, an investor perspective, but also from a geographical perspective. And I think it's very relevant, and thank you for the organizers here today having invited us, the focus on the Middle East, on countries that are around the Mediterranean areas, which have a lot of sun, a lot of wind. So certainly we are looking at those as very interesting opportunities.
Hi, everyone. My name is Kevin Teo. I'm a principal within the clean energy team at Capital Dynamics. So Capital Dynamics is a fund manager with different strategies, fund of funds, secondaries, co-investment, but I sit within the clean investment team where we invest in clean energy real assets like solar farm, wind farm, batteries. We started business about 15 years ago, and as of today, we have about more than 2 gigawatt of assets across Europe, and our main focus is primarily in Europe at this point in time.
Yeah, and you know, as I mentioned, Bruce Huber, and I run an investment bank that's specialized on and wholly focused on energy transition. I've been operating in the energy markets, energy transition markets for 25 years. We're doing a range of M&A, structured finance, and capital placements across infrastructure right through growth equity. I'm really delighted to be here and with this distinguished panel. We're going to dive right in and talk about some of where the opportunities are for capital to solve the energy transition problem, but dive into some of the problems. And you know, the first big issue that we're all facing is a phenomenon where we've had and been spoiled by 20 years of subsidy. Those subsidies are now beginning to drop away, and this is challenging the traditional infrastructure capital deployment model. And I'd like to perhaps turn to Barbara. Barbara, you've written several books on the topic. This whole transition between infrastructure, which with a need for contracted returns, and a world that is moving into real assets and growth equity, and a perspective on how to deliver the risk return profile that capital is looking for in a capital intensive world. How are you dealing with this issue of a world of dropping subsidy?
Thank you. Now, we have decided that we're going to be brief and crisp in our answers, so I may not say everything I could say, but then keep you awake. That's the kind of the balance we are trying to strike. So subsidies obviously are given to get a market going, and once it's going, and the costs have come down sufficiently, then they should go away, right? Because otherwise you're paying, you're using taxpayers' money to enrich investors. I don't think that's the right thing to do. So I think it's correct for subsidies to go away in areas like wind and solar, where you can make money without subsidies, and focus on those. We call it next generation infrastructure, not necessarily new technologies, but what's the next thing which is needed, right? If you think, there was a subsidy needed for batteries, which there was, right, at some point, I think we got over that. If we all see what's happening in the battery market, prices have come down and investors are bullish, right? So then I think subsidies are a great way of introducing a new market and making it grow, and the moment it has been picked up by investors, I think they should stop, and then stop crying, but just make sure you make the right investment decisions at the right time. And I think we are all also taxpayers, and so I think we should care for the public good.
Yeah. So I'm going to bring Kevin in on this, because Kevin, you've been investing very heavily in the in asset classes that are delivering a secured rate of return. How are you delivering for your investors at a time where those subsidies are dropping away and you're needing to provide that confidence of cash flow?
Yeah, thanks. So I think subsidy is not the solution, or might not necessarily be the solution to attract private capital. We have seen what happened in Hornsea 4, for example. They won a CFD, 9 months later they dropped it because economics can't work. I think it goes beyond just subsidies itself. I think it's a whole policy regime that needs to be tied in together, right? If you want to attract private capital, for example, I think the panel earlier spoke about the US with what Trump is doing. It kind of, to some extent, pushing away some of the private capital that might want to invest in renewable asset classes, for example, in the US. I think besides just subsidies, there are other things that we as investors are quite concerned about as well. For example, can you secure a grid connection into the grid? What are the wider policies in place as well that supports, I guess, renewable asset classes? For example, batteries batteries, for example. In the UK, I think the grid reform has done quite a lot. There's a lot of revenue opportunities for battery assets, but in other countries, let's say in Spain, for example, you don't really see the battery market maturing yet, and that's because there's not the right policy in place over there. And I think going back to Bruce's question, right? So what are we doing? Ultimately, we are agnostic between whether there's subsidy or not. Ultimately, we pursue a risk-reward perspective, right? If there is sufficient, I guess, alternative fixed revenue model, let's say corporate PPAs out there that provide a price good enough for us to make our investment returns, we will happily invest in those. But I think it just needs a more holistic environment. We look at each investment opportunity holistically and see whether it makes sense, not just whether it's subsidized or not, but holistically from a whole policy perspective, whether we are able to achieve our returns.
Yeah, and Kylie, maybe I could bring you in here because you're taking a very different approach.
Yeah, I mean, where we find it very interesting from the development side is basically we have a discipline which is kind of similar to what we were discussing before, is that even though you go in very early stage, which could be at the pre-NTP level where you're just doing the feasibility and early stage engineering, but what you do is you lock up your offtake. So if you can get those precedent agreements on your offtake, then it kind of makes the whole project very viable. And then you also get the upside of having started the investment at the very early stage. So your multiples just keep aggregating, essentially. And then the beauty of the business model, essentially, is that your offtake a lot of times are investment grade. So then you can just structure your offtake as an investment grade offtake, and then you can pull in very affordable capital. Your capital structure is efficient, and you're able to kind of go in with very kind of lean, efficient early stage equity capital, layer it up with debt along the way, and so your returns are actually extremely strong. And the beauty of it is like you take that early stage risk, but then you're locked in with investment grade offtake. So it's a very nice business model, really. And so if you integrate similar to the previous panel, if you can integrate that development and some of the engineering in-house, or at least with some sort of joint venture or sort of ROFR with your developers, then you have a really strong team and infrastructure to actually be able to execute the projects.
Yeah. Barbara.
I would like to just jump in there, because what I think the point there is that you want to study the business model, and there are business models which lend themselves to this off-take type of, and supply and off-take type of contracts, and there are some which do not. A very, one which has been used quite recently, quite a lot, and most investors weren't too happy now, is the EV charging, right? The EV charging where you take volume risk and demand risk. How ugly is that? And you can't lock it in because you're going to sit there and wait for a car to come by, and you don't know how much they're going to tank. And I don't know of any business model, but maybe you do, or of any investor who says we are up to plan. Now, you still want to try to get EV cars onto the road, and so I think you need to scratch your head first before investing and try to change the business model one way or the other to come to something where you do not take volume and price risk, right? And so I think this makes exactly that point, and I think this is exactly the reason why the investors have been unhappy with their EV charging. Now, you can do fleet arrangements, you can do, with businesses, you can solve the problem. I'm not saying you can't solve it, and there are by now business models out there, but the initial investors went without those, and they weren't happy.
So I'm going to pick on Nicola for a moment here, because we had this discussion as to whether this energy transition has abandoned, the infrastructure investor, and now we're moving into a private equity or growth equity around real assets. And this is a big issue. I think a big issue for the room in a world that we've really come to expect energy infrastructure would be delivered a contracted return, and those seem to be far and few between.
Well, investors have these two buckets, and they will continue to have these two buckets. And so, just to link with the previous question, subsidies, the new form of subsidy in terms of FD and contract for differences or offtake agreement coming from governments are certainly very, very welcome and needed. You know, you see what's happening here in the UK on the offshore wind side, where there were no bidders because the market has basically seen through. And you know, in Italy, in Southern Europe, there is a very big scheme rolled out by the government to support the rollout of batteries. You know, there is a novelty risk. There is a capital risk. You know, the capital is actually still, you know, is expected to come down dramatically and has already come down.
So Nicola, just so are you advocating this is a bit of the infrastructure investor focuses on those CFDs, focuses on the capacity mechanism subsidies?
It definitely does.
Chases the regulatory subsidies.
Exactly, because it allows our investors and, you know, ourselves with a very targeted approach to deliver double-digit returns in real assets, which will continue to do that. Obviously, there is the famous say, which is time value of money, which is the big question of investors in real assets, is that if you are buying a ready-to-build project, it has to be ready to build. And we know that across Europe, that is not the case. It's a very specialized business to deliver double-digit returns into real assets.
But some would argue those big CFDs are not double-digit returns; they're tweeners, or with potential a little bit more risk, and which is not. Well, that's
where you know, if these are coming, you know, the corporate world has been delivering very good PPAs, as we know with our friends at Capital Dynamics, where we've done projects in Spain, which very solid PPAs with BP in one case. You know, that delivers very good return. Obviously, it allows the project to be a little bit geared, and so the returns can achieve those returns. But coming back to your question here, is the world, you know, the more and more merchant risk investor are taking, and the more and more we are getting into an energy transition private equity play. Is that a natural transition? I think it is. You know, EV charging, as we say, it's a big opportunity, but it's also a big risk.
So can I ask, and maybe this unfair question, because we didn't even prep on this, but it's really a question of, you know, we've lived in a world where the last decade, we've had a world of infrastructure investing at single-digit returns. You know, are there any areas of the market where we feel with the risks of subsidies dropping away and regulatory change that single-digit returns are sufficient for any of you as investors? Yeah.
I don't like marketing. However, we have been propagating for the last 15 years continuously 6 to 8%. In the lower mid-market, because the risk profile I thought was appropriate for 6 to 8%, 20-year feed-in tariff Germany, or you know, or other long-term contracts, and very de-risked, very little leverage. Our actual realized is 16.6. And why? Because we buy well and we sell well, and in the middle we do something right, and we gather and we build platforms. So again, I stopped the self-marketing, but what I'm saying is, I think there are, you know, this lower mid-market, most people have moved out of it. Why? Because the economics of bigger funds are better for the manager. We all know that, right? So actually, by now having a crowded mid-market, if you stay in the lower mid-market, you have a great sales, you know, you can sell into a juicy market because they are waiting for that. They are waiting until you have gathered the little, you know, you've done the legwork and you've gathered it all, and then you have a multiple, you know, EBITDA multiple arbitrage and hopefully also something else good. So I think there are ways to make money with low risk.
Okay, yeah. So you are investing at single. We can tell the world you are investing at single digit.
And we are making double digits, exactly.
Very good, good.
Yeah, I would like to add, Kevin, on that. Yeah, so I think it's not true that subsidized asset will perform better than merchant assets. For example, non-subsidized assets. Let's say 2021, 2022, when there's high gas prices, right? If you have CFD, you know what your revenue is. But if you do just pure merchant, your revenue will be through the roof, right? And that's one case whereby non-subsidized asset actually do outperform subsidized asset, and there's a lot of opportunities to do so. At the same time as well, for subsidies, let's take CFD, for example, in the UK, there are definitely risk and downside that you might not see for other, maybe non-subsidized assets that have like long-term corporate PPAs, for example. So negative pricing. For CFD, if there's negative pricing, you do not get your CFD price. But for corporate PPAs, it's possible to negotiate contracts whereby even at negative prices, you still get whatever PPA price you achieve, and probably a lot more relevant as we move towards a world where you see a lot more negative prices, for instance. And just one other point, I think going to what Nicola mentioned earlier, right, there's going to be a subsidy scheme for battery assets in Italy. In Germany, I don't think you really see that's the case, but the German battery market is booming. And I think that really boils down to regulation, having the right reform to really spur the growth of battery assets, having the right revenue streams. And I think markets need to evolve. I think this is an energy transition. Different countries' regulations are changing differently. As I mentioned earlier, UK in the best market, they're way ahead of the game. In other countries, Spain, Italy, I think they're still catching up. But Germany, I think people are telling me that it's the next. It's probably where UK was maybe 2-3 years ago, and it will grow, and probably other markets will catch up as they really reform the grid and make sure that it really attracts private capital to all the different asset classes.
Yeah, I think one of the things that we're talking around is the fact that these historically low volatility real asset classes in the energy transition, they were historically low volatility, and now we're in a world of higher volatility and asking ourselves how to monetize that volatility, and hence this shift to managing offtakes more proactively and managing volatility more proactively through asset classes like such as batteries. But it does feel like a two-speed market. And Nicola, you've talked about chasing the capacity mechanism of the subsidies in those markets. Kylie, I think you were talking about being more oriented around merchant exposure.
The merchant, at least in the U.S., so I'm based in the U.S. I used to be in London for 14 years, so I do transactions across Europe, the U.S., and we're looking into the GCC as well. But the big merchant play in the U.S. is really the battery storage, and it's primarily within Texas, because there's 2 grids in America. There's one in Texas and one for the rest of America. So the grid in Texas is a standalone unit, and the battery storage, and it's unregulated, so you can basically do the arbitrage and the merchant strategy. The downside to it is basically if you want to have a very efficient capital structure, you can't get as efficient capital structure on a merchant play, because they don't want to take the volatility risk in terms of from a banking point of view. So as an underwriter, you just have to get comfortable with the fact that you're going to have less leverage, more upside, but volatility in terms of your cash flows. So that's the play on it, essentially.
And so can this room get comfortable with any assured minimum returns in that asset class?
People can round it out. There's a lot of historical data now, coming out of a lot of, standalone battery storage sites. Because for us, we use a lot of the battery storage as backup power, adjacent to natural gas, adjacent to solar. So for us, it's an adjacent type of solution. We don't typically do a standalone pure play merchant, best strategy, essentially, just because it just doesn't work with the way that we like to invest, and also the capital structure we like to layer in. So we like that security. For us, we're underwriting to 25% minimum IRRs, and we can achieve that because we go early stage. So we'd rather do the earlier stage risk rather than the merchant offtake risk.
And I'm sorry, Nicola, you're going to come in here because we are seeing a world of subsidies,
I think there is there is obviously the cannibalization risk that is now appearing very strongly in Spain, in Italy, and in other countries where the intermittable renewables is coming at certain times, and that is particularly for solar, where you have times where negative prices, and where the grid can't really absorb whatever you produce, so you basically shut down. And so from an investor perspective, a specialized investor perspective, the market is really a combination of managing the merchant upsides, which differ from country to country, And then having a BaaS platform strategy where you can't have only the production, but you have to have also the storage capacity. And that is really the future, where you can insert at certain times in the early part of the market certain offtake agreements, incentives or incentivized by governments to try to foster the development of delocalized storage, which is very, very important. You know, all our projects have also storage capacity. We wouldn't invest if we have only, you know, a PV solar, even if it's utility scale. So it's a combination of factors, but definitely the push towards managing the merchant risk is considered for us an upside, not an additional risk.
I'd like to tease out maybe where the safe harbors are. You know, we're in this world of subsidies dropping away, some regulatory change. You know, in some of our preparatory discussion, we talked about safe harbors being potentially behind the meter or tapping into data centers. It'd be helpful just to understand where you know, when we communicate with the LP investor community, how to defend returns in this changing subsidy erosion environment.
I mean, we take the stance that, you know, our investments are fairly short term. It's basically the duration it takes to start a development and get it operational. So we're looking at it between an 18-month to 36-month duration on our assets. So our aim is to go build it and exit. And so by exiting with that secured 15, 20-year offtake, you get your multiple on that, and you're able to exit, you know, well. But in terms of duration,
so is that growth equity, or is that a hedge fund strategy?
I'm not quite following, but but I mean, if you're using battery, natural gas, and solar, you can get these projects even now still up and running, usually within a 24-month. 36-month, and then what we're doing, because we are doing behind the meter to data centers and to industrials, because in the U.S. There was a lot of DOE loans, you know, given out to companies, and part of the requirement of the loan is that they use green energy to power them up. So we're working with a bioplastic manufacturer, and basically they need more green power. So we'll go on site and we'll design a solution on their industrial site, and we'll go power them up on site. So for us, we feel like we're providing a solution. It doesn't take us that long. It's where an investment that typically has not come from people like us, and also people didn't have an issue getting power before. So this is a new problem that we are solving that hasn't needed to be solved until 9 months ago, when the northeast of the U.S. decided not to issue any more PPAs to large-scale projects. So that's kind of the world that we're living in, at least in the U.S., is that you cannot get grid power for large-scale projects anymore. So if you don't have developers and skill sets to figure out how to do behind the meter, then you can't get your projects up and running.
Yeah, but we're trying to mobilize hundreds of billions, not millions or a few billions, but really massive amount of capital in this transition. Can we move the capital fast enough behind the meter for particularly that industrial behind the meter market where it's needed?
I think there's plenty of money to go. I think the problem is, you know, supply chain. I think the problem is a lot of, you know, tariffs and noise in the market. So, you know, there's a lot of uncertainty in terms of, you know, getting things done these days. So I think that's kind of a problem as well.
Well, another big factor is that, as you know, Europe is a lot of different Texas. You know, the grids are completely different. Spain, Italy, and various countries, and we are relatively little interconnected. So where power prices are going to be, it's going to be really the game changer. Because if you see where power prices are in Spain and in Northern Europe, we are, you know, around, you know, 20 to 40 maximum euros. If you go to Italy, you have a spike. You have over 100 euro per megawatt hour. So it really depends on where these prices are going to be settling in the medium term. And certainly we were all used to have very generous energy prices, and now it's a different world, and we really need to see the numbers coming out at the end, at least on the higher end of the single digits. Otherwise, investors, as the previous panel said, they're more attracted by the debt in infrastructure rather than taking certain risks.
So who sees capital slowing down into this market? Are we seeing an acceleration or deceleration with the headwinds that we've seen?
Okay, now I just answer both questions. I see a growing amount of capital going into infrastructure. And there are more and more investors who didn't have an allocation to infrastructure yet are still opening up new pots. So I think that's, and also the incentives and the allowance of pension funds. I mean, many pension funds haven't been allowed to go into infrastructure or only to very small extent. So that is growing. And so that I think is good news to finance the transition. On the safe haven, of course I don't want to say I have the safe haven, but here is an idea, right? What we have been focusing on increasingly within our platform building approach is, one is the sub-metering and then smart sub-metering. You may have heard that, Partners Group and CDPQ were selling Techem, what's one of the two big German players, to TPG. Last night it was announced that the deal fell through, by the way. And so this sub-metering is, which we're doing in Germany, it's exactly like a small ISTA or small Techem. And the nice thing there is you have between 6 and 10-year contracts, and you have historically 2% churn. And I spare you the rest of the details. So that's pretty nice thing. There we do a consolidation strategy, and it works well. Let's put it this way: it works well, and people love it. And I'm sure we're going to exit this fantastically once we have it all gathered together. There's a regulatory change in 27, so that drives consolidation. Then there's another area which is very adjacent to this, which is also not new, but again, reasonably safe. Is this so-called energy contracting? That's the terminology which has developed. In a way, it's like leasing. It's a leasing of heat water pumps and whatever needs to be invested in houses for all those people who can't afford it. In the Anglo-Saxon world, this is very common. The Anglo-Saxon guys, sorry to generalize, they love leasing. Whereas on the continent, and again, particularly in those, for instance, Nordic and DACH region, Germany, Switzerland, Austria, people buy. They don't lease, they buy. But now with all this capex necessity, also for people who may simply not have the money, this is a growing business. Again, lovely long-term contracts. And it's a legwork exercise again, However, I think there are always solutions. And for instance, to stabilize the transport and to stabilize the heat, right? We think biomethane is a good way to go, right? And so we are working on that. And so I think the idea is to just use common sense to think, okay, what's the next sector which needs a solution? Where does it stand? How can I come up with a business model which I can structure in such a way that I can sufficiently downside protect it? Sufficiently for my needs, right? When that may be different for different investors. Let's stop here.
I'm going to just shift gears a little bit and ask about, everybody wants to know about where, whether there is a data center opportunity that we've got any visibility on. We see it big time in the U.S. There's a sense of hype here. Is it real or is it hype?
I think it's 100% real. There's a bit of an AI war going on, and so to power up the AI data centers and be able to process it, the robots are coming. There's just an enormous amount of power. This is not going away, and the data centers are critical. It will be spreading out to other geographies as well. In the U.S., obviously, there's very strong demand, given our tech sector and our government and the military. and the people who need it are people who have endless balance sheets. I mean, the top tech companies have endless money. They can easily put down billions upon billions of capital to develop, and they're in a race to win it. So I think I think the only thing that we're really hindered by right now is, frankly, tariffs, delays on machinery, and the fact that the tech is improving so quickly. You know, there's like an instance where one data center, they put in billions, and then they're like, oh, we need to change the racks and redo it because there's new technology and coolant, and then they redid the whole thing because they didn't want to build a data center that was going to be out of date in, you know, a year or two. So I think it's more the underlying details that are causing some issues as well as some of the macro, but the demand is insatiable.
So I would pose that that's a very U.S.-centric view. And you know, we look at what's happening in Europe and the UK, and it's still cloud-based services, location, 50 kilometers from a tier 1 city. Do people see that differently on this side of the pond or outside of the US of A?
Well, from our perspective, we see it a tremendous opportunity also in Europe. Obviously, location is very important. But again, it's a combination of the long-term offtake agreements and management of these data centers to optimize financing, and the integration with other, you know, green energy sources that we can put together or we can source in the market. So that is the combination, again, from a combination of market risk, merchant risk, which I think, you know, there is a perception in the market that it's a tremendous opportunity, so it's a manageable risk, but it can't be 100%. It has to be backed by, you know, very solid corporate offtakes and that utilize these data centers.
I mean, I'd like to open up to any questions from the room, and maybe I just summarize. You know, I think what we've heard on this panel is that you know, with subsidies dropping, there's a defensible behind-the-meter strategy. There's a defensible SPV level strategy. There are areas of niche subsidies that continue, and I think we've heard that you know, that this is a market that's moving and taking on more risk and more more private equity and growth equity opportunities, you know, relative to the traditional contracted infrastructure. And I'd love to see. I don't know if there's anybody who would like to pick on this gentleman here. Pick on any of the panelists.
One of the points I'm noticing is that everything here is about electricity. Is there any comments on what's happening in other forms of power, hydrogen, and particularly hydrogen in that area? We are decarbonising buses and trucks. We're using hydrogen. We're using hydrogen internal combustion.
Yeah.
Thank you.
Yeah.
James Budget, Meteor Ventures.
Yeah.
We are decarbonising buses and trucks globally, using hydrogen internal combustion engines, and we're not hearing much comment about anything outside electricity.
Yeah.
Any comments on hydrogen? Drill baby drill was one of the comments made earlier. Drill for hydrogen is one way forward. Trump's half right.
I think there's a lot of interesting opportunities for hydrogen. I think it's still a little bit early stage in terms of having mass offtakes with it. The U.S. in general is a bit adverse to hydrogen just because we just have a lot of, you know, affordable, accessible, you know, energy solutions outside of hydrogen. You know, people have I would say, an immature view of hydrogen and its capabilities just based on the past. I also think the offtake on hydrogen is still slightly above market to comparable solutions. So I think there's that issue. But I think where it could be really good is, you know, in and around the ports, you know, that type of stuff. And I think, you know, I think Toyota is doing a lot in terms of powering up their vehicles and motorcycles with hydrogen. So I definitely think there's a good opportunity in the market. This also takes 4 to 5 years to build a hydrogen sometimes these, if you're doing kind of a full cycle. So I think there's also a lead time, thought process behind it. But look, I think hydrogen and other clean fuels are a very interesting opportunity. I think a lot of people have had issues with the electrolyzers, that they break and they lose efficiency right away. And so they're cheap enough that they have redundancy, but it's a bit messy. And also the feedstock into other biofuels have caused a lot of issues. And there's been one that completely blew up the whole factory and a 500 million went away.
Barbara, I don't want to be too negative. I'm going to cut across you. I'm very negative on hydrogen. I think it's a 10 to 15 year investment, not a 3 to 5 to 7 year investment. We see it as way out of the money. And so I think you have to be very long-term in your thinking to see a world where that is in the money opportunity. But there are niche specialists, location situations where there are off-takes that are prepared to take a hydrogen derivative, but it is by far and away a niche, highly subsidized market today from our perspective. But certainly welcome others' views. Any other questions from the room?
I mean, I can add in, right? I think why we talk so much about electricity here, because I think the business model is very well established here, even with renewables coming in. The electricity market already exists, so it's a lot easier for infrastructure funds like ours to really come in and step in and come up and just hedge on to the existing business model. I think hydrogen is a whole new business model. There's demand. All right? I think we're not sure where demand is coming from, right? There's a transition, but demand is waiting for supply, while supply is waiting for demand to be there. So there's a circular loop, and I think things need to work in tandem. Otherwise, it's quite hard as well, I think, for the hydrogen, sector to really grow exponentially, such that it can support all these hydrogen projects as well.
I tend to agree.
Conscious of time. Are there any other questions we should just pick up on topics that are other than hydrogen?
Line here. Anybody wants to have a mic?
Nicola, back to you, because I think you had a...
Just very quickly, just to say that, there are a lot of technical issues on the hydrogen side, as you know. So natural gas is actually much more safe and affordable. So green hydrogen has, 6 times more cost than other form of production of hydrogen. So if you look at it from a renewable perspective, green hydrogen is absolutely at the moment not a priority, and it's not really attractive.
Can I make one quick reply?
Yeah, please
I'm
do.
very glad to hear those answers, because that's what I'm getting everywhere. We're quietly coming in underneath, and actually we're looking to take quite a few 100,000 tons of hydrogen before 2029. There are ways forward, but it's a very interesting reply.
Yeah,
Thank you.
I'm just going to counter it. Just say we've seen a renewed interest in gas-fired generation because natural gas is probably the cheapest form of molecule for that Dunkelflaut or the extreme, the long-term storage application. Those 6 or 7 days of the winter where one has real stress. I think there's a hope and expectation that we'll have a clean fuel alternative over time, but I think we've got some yards to travel before we get there.
Now 2 comments. One is, don't be too cheerful. I'm thinking hydrogen is good, and I come back to that in a second. But no, never mind. And before that, I did mention biomethane, didn't I? And the reason why I focused on that rather than mentioning hydrogen is obviously because you can use the grid, right? You can use the existing grid, and since building a grid also means a lot of new infrastructure, that means destroying nature, that means CO2, it needs a lot of infrastructure. So biomethane is a faster way to get renewable energy into the heat grid or also into the cars, right? And because I totally agree with you, there's far too much power price risk out there. So that's my first comment, that we do this consciously because I think it's important. On the hydrogen, we are more inclined, I'm not saying electrolysis is a bad idea. Most people focus on electrolysis. We think the circularity approach, which is basically meaning waste to hydrogen. And again, it's not that we only do business in Germany, but in Germany you can still get 20-year contracts, off-take contracts, and you get your gate fee. And if you place it in this where the steel industry is, you have no issue of, oh well, then I quickly convert the hydrogen into ammoniac, and then I quickly transport it onto a ship, and I quickly do it. I mean, yes, you can do that. It adds a lot of risk, it adds a lot of costs, and I'm not a believer in that. So unless you can generate your hydrogen where you use it, and if you do it in the steel industry area or whatever heavy industry, and you build your pipe, and the pipe is a kilometer or two, and then you basically, you as a hydrogen producer, you have, you deliver to that grid, and then you're off, right? And the off-taker, which is the corporate, that builds that little bit of a pipe, right? So that's a clear cut, and I very much agree that it's good because, and there is existing demand. I mean, if you focus on hydrogen trucks, well, I wouldn't want to bet on that one. But if I have an existing demand, and there is an existing demand of hydrogen, and we know who takes the hydrogen, and we know who needs it, right? So they are waiting for us to produce the green hydrogen, and the moment you have it, they will take it, right? So I'm totally on it, so good luck.
Thank you.
Good luck.
I'm conscious we're reaching the bitter end, probably running a little bit over and starting to get some looks here. So please join me in thanking our panelists and for this discussion.